Welcome back to the deep dive. We have a fascinating and frankly kind of mysterious document on the table today.
Yeah,
Usually we're parsing through, mainstream news, academic journals, maybe a white paper,
uh,
but
uh,
this is different.
it is.
It's titled Manal Mehta's Market Intelligence, and honestly, it reads less like an equity research report you'd get from a bank
Oh, for sure.
and more like a confidential dossier that someone left on a park bench in D.C.
It certainly has a distinct flavor, doesn't it? It's dense. There is absolutely no fluff here.
None.
Manal Mehta isn't trying to sell you a subscription or get a click a link. He's trying to map out a very specific, very chaotic moment in the global markets.
Right.
It feels written for an audience of one, or maybe a very small room of people who pull the actual levers.
The scope is what threw me at first. I mean, we are jumping from a $2 trillion wipeout in the software sector to the structural biology of dementia.
And then fire trucks.
And then over to a legal battle about fire trucks in Los Angeles. It feels so disjointed until you step back. Is there actually a thread tying all these things together?
There is, and it's a powerful one. If I had to boil this entire dossier down to a single word, it would be bifurcation.
Bifurcation.
Yeah. The operating thesis here is that the market, and really the physical world itself, is violently splitting into two categories, the real and the fake.
Okay.
And the warning Mehta is giving is that if you are on the wrong side of that split, the financial consequences are going to be, well, devastating.
Real versus fake. It sounds almost philosophical, like something from The Matrix.
A little bit, yeah.
But the numbers here are brutal. You mentioned a $2 trillion wipeout. That is a GDP-level event.
It is, and it sets the stage for our mission today. We need to parse this dossier to understand why capital is fleeing the fake economy of easy software margins and rushing into the real economy of atoms, energy, and deep science.
So let's start exactly there. The software Armageddon. The dossier opens with a section on the great AI rebranding, and it describes a scare trade. Walk me through this.
Okay.
We've been hearing for 2 years that AI is the biggest boom in history. Why is Mehta calling it a wipeout?
Because we have to distinguish between the companies building the AI and the companies threatened by it.
Yeah.
For the last, 10 or 15 years, what was the easiest way to get rich in the stock market?
Software as a service. You buy the cloud stocks.
Right, the subscription model.
Yeah.
You pay $50 a month for your CRM or your database, and the company just sits back and collects the check.
High margins, recurring revenue.
The dream, exactly.
Yeah.
It was the golden goose, zero marginal cost of replication. I mean, once you write the code, selling it to the millionth customer costs you nothing.
Yeah.
But Mehta argues that golden goose is being cooked. This scare trade is a massive repricing of that entire sector.
Okay.
Investors are looking at these legacy software companies and realizing that AI is deflationary for them.
Deflationary? How?
Well, if an AI agent can write code, manage a database, or organize your sales leads for pennies, why are you paying Salesforce or Adobe a premium?
Their whole moat just dries up.
It dries up. The scare isn't that AI is fake. It's that AI destroys the pricing power of the existing software giants.
So investors are looking at these safe, boring software stocks and realizing they might be the next Kodak.
Precisely. And the market's reaction is panic. They are shooting first and asking questions later. They are dumping these stocks, which explains that $2 trillion market cap erosion from the peak.
And the company's response.
Panic rebranding.
The dossier is pretty cynical about this. It mentions .ai domains and sparkle emojis.
And that is the fake side of the bifurcation. You have these terrified legacy companies slapping a generative AI sticker on a 10-year-old product.
Right.
They're adding sparkle emojis to the interface, hoping you won't notice that the underlying business model is under siege. But the market isn't falling for it anymore. The smart money sees the sparkle emoji and runs the other way.
Okay, so if the money is fleeing the sparkle emoji software, it has to go somewhere. It can't just evaporate. Where is it landing?
It's rotating. It's rotating into the real, Mehta calls them the picks and shovels monopolists.
The infrastructure layer.
Exactly. If you believe AI is the future, you don't buy the shaky software application on top. You buy the concrete, the copper, the energy, and the silicon.
So we're talking about companies like Broadcom, AVGO, and TSM.
The irreplaceable centers of the ecosystem. I mean, think about TSMC. They are the foundry. Almost every advanced chip in the world comes out of their factories in Taiwan.
Right.
You can have the smartest AI code in the world, But without the physical silicon from TSMC, it's just math on a whiteboard. It's not real.
It's a return to tangibility. The report mentions Amazon spending $200 billion, but they aren't spending it on marketing.
Not on marketing, no. They're spending it on catch-up, on physical data centers, on custom silicon.
Because the real economy is capital intensive.
Immensely. You need massive amounts of energy and materials. And that's why Mehta sees this rotation out of fluffy tech and into energy and materials sectors. You can't run a large language model on good vibes or brand recognition. You need gigawatts of power.
This focus on real versus fake isn't limited to tech, though. The Dossier takes a hard pivot to Detroit. And I have to say, this section, Detroit's sedan gambit, it feels like a vindication for anyone who's tried to buy a car recently.
It's a scathing critique. Mehta calls the U.S. auto industry strategy a generational blunder.
And this goes back to the decision by Ford and GM to basically kill the car. No more Fusions, no more Cruises, just SUVs and trucks.
And at the time, the logic, it seemed sound on a spreadsheet. Trucks have higher profit margins. Americans love big cars.
Sure.
But they made that bet assuming a permanent bull market for the consumer. They didn't price in interest rates rising or inflation squeezing the middle class. They assumed fake, money-cheap credit would last forever.
The stat in the report is staggering. The average new vehicle price is now over $50,000.
That is the bifurcation right there. $50,000 is fine for the top tier of earners. But for the average family, it's an affordability crisis.
A total crisis.
And by killing the sub-$30,000 sedan, Detroit effectively abandoned the entry-level market. They created a vacuum.
And nature abhors a vacuum.
Toyota stepped right in.
Yeah.
Look at the data Mehta provides. After Detroit exited the sedan market, Toyota's share of that segment jumped from 12% to 22%.
Wow.
They didn't just pick up sales. They picked up a generation of young buyers. If your first car is a Toyota, because that's all you can afford, you are likely to stay with Toyota when you upgrade later.
So Detroit traded long-term loyalty for short-term margin.
And now they are regretting it. The report quotes a GM president effectively saying he would kill to have a hybrid electric sedan in the lineup right now.
And Ford dealers are hearing from customers who missed the Fusion.
Exactly. It's amazing how quickly the narrative flipped. They thought they were optimizing the business, but they actually cut off their own feeder system.
It just ties back to the theme. A $50,000 truck you can't afford is fake demand.
It relies on cheap credit. But a $30,000 reliable sedan that gets you to work, that is a real need. Mehta's trade here is simple. Stay long the foreign automakers until Detroit proves they can actually build a profitable, affordable car again.
Let's move from physical cars to something intangible, but apparently just as heavy. Reputation. This section is titled The Epstein Contagion. It's a bit darker, but the financial analysis here is fascinating.
It is.
Because it treats reputation like a balance sheet item.
Right. We have to tread carefully here. But from a market perspective, this is crucial. Mehta's redefining reputation not as PR, but as a liability. The argument is that in 2026, reputational liability is as potent as credit risk.
Usually when a CEO gets in trouble, the stock dips, they apologize, maybe go to rehab, and everyone moves on.
But that era is over. The tolerance has evaporated. The source tracks the fallout from the Epstein files specifically. Look at Wasserman, the massive talent agency. The Dossier claims it is effectively for sale because the asset, the talent, walked out the door. High-profile clients like Jabal Rohn and Abby Wambach,
They just left.
they left. And in the service business, if your talent leaves because the founder is radioactive, your enterprise value goes to zero. It's not just bad headlines. It's a liquidation event.
It mentions ripple effects, too.
Yeah.
The CEO of DP World stepping down, a top lawyer at Goldman Sachs resigning. It feels like a...
Contagion.
Yeah.
That's the term Mehta uses. Reputational risk is now a systemic contagion. If you are an investor, you have to look at a company's leadership and ask, is there a ticking time bomb here?
So the alpha, the edge for an investor is what? Running background checks?
Essentially, yes. It's defensive. You screen portfolios for these risks before the headlines hit. You avoid the fake stability of a company that is actually sitting on a reputational landmine.
Okay, I want to get to the whispers. These are what the report calls second-order effects. The first one is, well, it's about fire trucks. And honestly, I did not expect to be talking about municipal emergency vehicles today, but here we are.
This is my favorite part of the report because it's so counterintuitive. It's a story about private equity versus the real world.
Yeah.
Los Angeles County is suing a private equity firm, American Industrial Partners,
Suing them for what? Exactly.
for rolling up the market. The PE playbook is standard. You buy all the small competitors in a niche industry, merge them into one giant company to cut costs, and then you raise prices because you have a monopoly.
Right.
They did this with fire trucks. But the lawsuit alleges that instead of efficiency, it led to equipment shortages and price gouging.
So fewer companies making trucks meant cities couldn't get their engines, and when they did, they cost a fortune.
Exactly, they broke the supply chain trying to extract value. But here's the whisper. This legal scrutiny is terrible for the private equity model of financial engineering. But it is fantastic for the incumbents who didn't play that game.
Like who?
Mehta points to Oshkosh, OSK.
They own the Pierce brand, right? The ones you see everywhere.
They do. They are the real manufacturer. While the PE firms were trying to engineer stock prices, Oshkosh was just building trucks. Now that the PE strategy is getting hammered by antitrust lawsuits, Oshkosh's moat gets wider. They become the flight to safety trade for every municipality that just needs a truck that works.
By the guys who actually make the trucks. Seems so simple when you say it like that.
That's the real, again, tangible product over financial engineering.
Let's look at another whisper. Apple. Now, usually an Apple bullish case is look at the new iPhone, but Meta points to AirPods.
This is the Apple unlock, and it's a brilliant observation on human behavior. The report highlights a very specific use case. Couples who speak different languages using the real-time translation feature on AirPods to sustain their marriage.
That's practically sci-fi. Like
Yeah.
the Babelfish from Hitchhiker's Guide. You speak French, I hear English.
It is, but think about the stickiness of that. If your ability to communicate intimately with your spouse depends on your AirPods, are you ever going to switch to Android?
Not a chance. You're locked in for life.
That's the insight. The real value of AI isn't the large language model sitting in a server farm somewhere. It's the hardware interface that puts that AI in your ear. Apple owns the interface.
So while Microsoft and Google are fighting over who has the smarter chatbot, Apple is quietly locking down the physical layer where the communication actually happens.
Correct. It creates a high-margin, intimate dependency. That is a much stronger moat than just having a slightly better search engine.
One last whisper before we get to the heavy science. China. We hear a lot about their economy struggling, but Mehta mentioned something called the national team.
This is a contrarian signal. In the West, we are used to markets running wild. In China, the state-backed national team has been actively selling stocks to cool down their AI rally.
Selling. Usually governments buy to prop things up when they're worried.
Beijing fears a bubble. They saw what happened in the U.S. with the dot-com crash, and they want to avoid that volatility. They want a slow, bull, market-steady, controlled growth.
So if you are betting on a massive, explosive AI rally in China,
You are betting against the Chinese government.
and that is a losing bet.
Exactly. Mehta's advice is to avoid the speculative, frothy AI names in China because the state is capping their upside. Instead, look for value in the big liquid tech companies, the ones in the KWA BTF that are stable. Don't chase the rocket ship, ride the train.
Okay, take a deep breath. We are going to pivot now. We've done finance, autos, geopolitics. Now we are going into deep science.
Here we go.
The dossier calls this forensic analysis of biotech. And I want to warn the listener, this gets technical, but the implications are huge.
This is where the real becomes incredibly tangible. It's the difference between treating a disease with a sledgehammer versus a scalpel.
Let's start with oncology, melanoma. The report details a vulnerability involving the SET1C compass complex. Now, I'm not a biologist, so help me out here. What are we looking at?
Okay, think of a cancer cell like a rogue factory. It's pumping out bad products, growing out of control. Standard chemotherapy is like bombing the entire industrial park to stop that one factory.
And it causes massive collateral damage.
It kills the healthy cells too. That's why chemo makes you so sick.
Right.
But this discovery identifies a specific switch inside that rogue factory, the SET1C compass complex. It turns out the cancer cell relies on this specific machinery to survive. If you can jam that gear, the factory shuts down, but the rest of the city stays safe.
And we can flip that switch.
That's the breakthrough. It's called precision epigenetic silencing. Using tools like CRISPR, which companies like Vertex, VRTX are developing, you can theoretically turn off the genetic instructions that the cancer relies on. You don't poison the cell, you just strip away its ability to function.
That is a massive shift from chemical warfare to genetic engineering.
It's the ultimate expression of the real. It's not guessing, it's mechanics. And that applies even more to the next section, dementia, specifically frontotemporal dementia.
This part blew my mind. The report talks about the shape of the disease.
Structural biology. Scientists used cryo-electron microscopy. Imagine a microscope so powerful it can freeze proteins in mid-motion and take a 3D picture of them, atom by atom. They map the actual folds of the tau filaments, specifically a mutation called S305I.
What does the shape matter so much?
Because biology is basically a game of lock and key. For decades, we've been trying to cure dementia by throwing random keys at a door we couldn't see. We were guessing at the shape of the lock.
And now we have a photo of the lock.
We have a blueprint. We know the exact geometry of the fold. This means companies like Lilly, LLY, and BIIB can stop guessing. They can design small molecules or biologics that fit that specific lock perfectly to prevent the protein from clumping.
So we are moving from let's hope this works to we design this to fit.
It's a move from alchemy to architecture. And this leads to Mehta's killer experiment. This is the synthesis engine.
This is where he combines the business logic with the science. What's the proposal?
He suggests combining that structural knowledge, knowing the 3D shape of the proteins, with AI machine vision.
So teaching an AI to look at the disease in a patient.
Exactly. The proposal is high-throughput structural proteomics. You take a sample of spinal fluid, and instead of a chemical test, use AI to visually scan for those specific protein structures.
So if the AI sees the fold, that matches dementia.
You have a diagnosis.
Yeah.
And you can catch it years before memory loss starts.
Years.
It moves neurology from a wait-and-see approach to a proactive engineering problem. It's incredibly hopeful, but again, it requires being on the side of the real. You need the real data, the real structure, not just a symptom checklist.
It really does tie everything together. Whether it's software, cars, or cancer, the winning strategy is depth. It's about the underlying infrastructure.
The fake is the hype, the easy money, the sparkle emojis, the $50,000 truck you can't afford. The real is the precision medicine, the chip foundry, the fire truck manufacturer.
So what is the philosophy for the listener? How do they apply this tomorrow?
The philosophy is that alpha profit, edge lies in being a contrarian, but not just for the sake of being difficult. It means having the discipline to buy the boring stuff when everyone else is chasing the shiny object.
By the unsexy infrastructure.
Exactly. Don't buy the wrapper, buy the thing inside, don't buy the AI domain name, buy the copper wire and the silicon, don't buy the hope for a cure. Look for the companies targeting the specific molecular structure.
Before we wrap up, we have to leave the listener with the final item on Mehta's forensic watch list. This is the provocative thought for the day.
It's a good one.
It's about a company called MBI, and the Supreme Court.
This is a classic special situation. MBIA is a zombie insurance company. It's heavily exposed to Puerto Rico's debt. Most of Wall Street thinks it's dead money just waiting to expire.
But Mehta sees a pulse.
He sees a calendar date. There is a Supreme Court ruling scheduled regarding a case called Trump v. Slaughter. Opinions are expected around February 20, 2026.
That is literally days away from when this deep dive is airing.
Right. The case is about executive removal power. If the ruling goes a certain way, it could dissolve the Puerto Rico Oversight Board.
And if that board goes away?
The bankruptcy negotiations that are crushing MBIA could be completely upended.
So a single legal ruling on a constitutional technicality could turn a zombie company into a goldmine overnight.
Or send it to zero. It is a binary event. But the point isn't to gamble on MBIA. The point is to ask yourself, are you watching the headlines or are you watching the court docket? The real information is often buried in the legal filings, not on the front page of the financial news.
That is the perfect place to leave it. The world is splitting into real and fake. Your job is to tell the difference. Thanks for listening to this deep dive into Manal Mehta's market intelligence.
Stay curious.